Hi, Jim Gore from Thor Wealth Management. Well, we, as investment advisors, we look for what is the best opportunity out there. And unfortunately, the best opportunities we see are offshore of the United States rather than being in the United States. I want to talk about that. The real reason for that, there's actually three reasons for that. First of all, is valuation. Second of all, is demographics. And then third is consumption that is going to happen around the globe. Now, first of all, let's look at valuation. Now, this is an indicator. Warren Buffett has his indicator to see if the US stocks are cheap or not. And the Buffett indicator, which is basically looking at the market value of the US stocks versus our GDP. And you can see back in 2000, the stock market was 159% of GDP. Today, it's 189%. So we're 40% over the valuation according to the Buffett indicator, than we were back in 2000. So the US market on its own is expensive. But let's do a comparison of the US market versus overseas. And this chart here looks at what is known as the CAPE ratio, cyclically adjusted price earnings ratio. The higher the PE ratio, the more expensive the market is. The lower, the cheaper it is. And right now, if you look at the world, ex the United States, the world is right now selling for half the price of US stocks. This is the complete opposite of what happened in 1987 when international securities were selling at twice the valuation of US stocks. That's when Japan was leading the world and they were overvalued. And we saw what happened there. We believe this will revert back. We don't know if the RPE ratio is going to go down or their PE ratios go up, but this is going to revert. And you're going to make more money and do better in international securities than you are in the United States. So there you have the valuation story for why international is a better place to be. But let's look at some other things as a growth side of it. And we like the emerging markets in the international arena better than the developed international markets. And the reason for that is that the demographics. If you look at the demographics of the emerging markets right now, you're looking at their population is 85% of the world. So they're almost 6 times more people than the developed world. But it's important to see what that population is. And if you look at the population, those that are under the age of 30, right now in the emerging markets, they have 9 times the population of people under the age of 30 than we have here in the United States. The United States grew very, very well in the 80s and 90s, and that was because baby boomers like myself came of age and we were spending money and consuming a lot of things. And that's what's going to happen in the emerging markets. So the demographics look good from the positive side for them being under 30, but there's also a negative side for the developed world. As we get older, we have higher costs. As the baby boomers sign up for Social Security and Medicare, it's increased cost for the governments and the societies. In the emerging markets, they're younger and they don't have those legacy costs, if you will. The last thing is going to be the consuming. And this is very, very important as those 30-year-olds, those under the age of 30 in the emerging markets are going to start to consume a lot more things. And if you look at this chart from 2010 to 2025, the amount of world's consumption is going to go up significantly in emerging markets from about 12 trillion to 30 trillion. And then you take this out even further to 2035, 2040, they're going to consume a lot more things than we are in the developed world. So we have a trifecta, if you will, especially in the emerging markets, is that you have cheaper valuations than the United States. You have the demographics that they're much younger and don't have legacy costs, and there's a lot more of them out there in the age of 30. And then lastly, they're going to start consuming. So it's going to be, as they consume, that's going to be growth opportunities for those countries and those companies, if you will, that are selling to consumers in the emerging markets. If you don't have emerging markets in your portfolio, as I showed earlier, 85% of the world is in the emerging markets. You're missing out a huge opportunity out there being in international securities. And it's something that we like right now much better than the United States.